Precious metals, particularly gold and silver, have long captivated investors and economists for their intrinsic value and role as financial safe havens. Recent developments in the market underscore the volatility and complexity of these assets as they continue to reflect geopolitical tensions, economic shifts, and investor sentiment. This comprehensive analysis examines current trends, technical insights, historical performance, global dynamics, and the economic implications of gold and silver investments. The precious metals market has seen significant fluctuations in recent weeks, with both gold and silver experiencing sharp price declines. Gold prices fell by $70 to $75 per ounce in an initial wave, followed by a further $20 drop, while silver saw a $1 decline, followed by an additional 10 to 20 cents. These declines can be attributed to a combination of technical factors and geopolitical developments. One of the primary drivers of this downward movement was the market's reaction to rumors of a potential Israel-Lebanon ceasefire. As these rumors spread, risk sentiment improved, reducing the demand for safe haven assets like gold and silver. This highlights how geopolitical events can have a profound and immediate impact on precious metals as investors recalibrate their portfolios based on perceived risks and opportunities. However, it's important to note that such price drops often present opportunities for long-term investors. Historically, dips in gold and silver prices have been followed by recoveries, as underlying demand remains robust due to their role as hedges against economic uncertainty. From a technical perspective, the recent price movements of gold and silver suggest that a market correction is underway. The Moving Average Convergence-Divergence (MACD) indicator, a widely used tool for identifying trends and momentum, suggests a potential upside crossover for both metals. This signals the possibility of bullish momentum in the near future. While the recent declines indicate that the bottoming process for gold and silver may be delayed, analysts predict a strong recovery by the end of the year. For gold, this could mean reaching new all-time highs, potentially surpassing previous records. Silver, on the other hand, is projected to climb above $35 per ounce, driven by increasing industrial demand and investor interest. Such technical signals provide a roadmap for investors, highlighting the importance of staying attuned to market trends and using dips as buying opportunities. While short-term volatility is inevitable, the long-term outlook for precious metals remains optimistic. Gold and silver have consistently demonstrated their value as reliable stores of wealth. Since 2000, gold has risen from approximately $270 per ounce to over $2,600, representing a tenfold increase in value. This performance underscores gold's effectiveness as a hedge against fiat currency devaluation and its ability to preserve purchasing power over time. Silver, while often overshadowed by gold, has also shown remarkable resilience and growth. During periods of accommodative monetary policies, such as in 2020, silver outperformed gold significantly. In that year alone, silver surged by 43%, compared to gold's 20.8% increase. This highlights silver's dual role as both a monetary metal and an industrial commodity, making it a versatile investment choice. The historical performance of these metals serves as a reminder of their enduring appeal. Whether during times of economic stability or uncertainty, gold and silver have consistently proven their worth as safe haven assets. The global landscape for gold and silver is shaped by the actions of central banks and governments. In recent years, central banks, particularly in countries like Russia, have been increasing their purchases of gold and silver. This trend reflects a growing recognition of these metals as global assets capable of providing financial stability and reducing reliance on fiat currencies. One potential scenario that has garnered attention is the divergence between physical and paper markets for gold. Analysts warn of a situation where the price of physical gold rises dramatically, while paper gold financial instruments like ETFs and futures collapses. This divergence would underscore the intrinsic value of tangible assets and the limitations of financial derivatives. Such developments emphasize the importance of owning physical gold and silver as part of a diversified investment strategy. By holding these assets directly, investors can mitigate the risks associated with market manipulation and financial instability. The concept of revaluing gold has been proposed as a potential solution to address the U.S. national debt, which continues to grow at an alarming rate. By significantly increasing the official price of gold, the U.S. government could theoretically offset a portion of its debt obligations. However, this approach assumes that the reported gold reserves are accurate and sufficient to support such a revaluation. If gold reserves are overestimated or fall short of expectations, a much higher revaluation would be required to achieve meaningful debt reduction. This raises questions about the feasibility of such a strategy and the potential economic implications. While revaluation could offer a pathway to address fiscal challenges, it would require transparency, international cooperation, and careful planning. The debate between the gold standard and fiat currency continues to shape discussions about monetary policy and economic stability. Under a gold standard, money retains its value because it is directly tied to a tangible asset. In contrast, fiat currency is subject to inflation and the erosion of purchasing power. An illustrative example is the performance of gold since 2000. An ounce of gold worth $270 at the start of the millennium is now valued at over $2,600, representing a substantial increase in real terms. Meanwhile, $270 in cash has lost significant purchasing power due to inflation, underscoring the advantages of holding gold as a store of value. This comparison highlights the enduring appeal of gold and silver as alternatives to fiat currencies. As governments continue to grapple with inflation and economic challenges, these metals remain reliable hedges against monetary instability. Gold and silver play a crucial role in protecting investors from inflation and currency devaluation. During periods of economic uncertainty, these metals act as safe havens, preserving wealth and providing stability. Their intrinsic value and limited supply make them ideal assets for long-term wealth preservation. The potential revaluation of gold, while controversial, offers an intriguing solution to fiscal challenges. By significantly increasing the official price of gold, governments could unlock new avenues for addressing debt and economic imbalances. However, this approach would require significant adjustments to the global financial system and a commitment to transparency. Gold and silver have long been revered for their intrinsic value and role as financial safe havens. Despite recent price declines, the long-term outlook for these metals remains positive, driven by strong historical performance, global dynamics, and technical indicators. As central banks and governments continue to recognize the importance of gold and silver as global assets, their appeal as investment options is likely to grow. Whether through direct ownership, ETFs, or other financial instruments, these metals offer a reliable hedge against inflation, currency devaluation, and economic uncertainty. For investors, the key is to stay informed and adopt a strategic approach to precious metals. By understanding market trends, leveraging technical analysis, and appreciating the historical and economic significance of gold and silver, investors can navigate the complexities of the market and build a resilient portfolio.